Today, we'll be taking you through a webinar on understanding fixed income products. So, in this webinar, we would be covering a basic introduction on the fixed income products, understanding what are the type of different fixed income products that are available for the retail investors, and what are the benefits of investing in these products, and finally moving to the understanding on the risk involved in investing in these products and how you can invest in these products with Altius. So, what are fixed income products? Basically, these are the investment opportunities that gives you a fixed return on your investments by paying out a fixed interest or dividend payments until their maturity date. So when you invest in a fixed income product, you earn a fixed return over a fixed tenure, and also the payments that you received are predefined, uh, and you are aware of those before you are investing in these products. Hence, these products carry a comparatively lower risk when compared to the listed stocks or unlisted stocks and all the other assets. So let's take a look at the different types of fixed income products. So the first one would be corporate bonds or NCDs. So a corporate bond is actually a debt security that a company issues in order to raise capital for its operations. So, or any other different purpose. So, a company would issue a corporate bond, and these corporate bonds are purchased by investors. So, these investors are at the end the lenders that lend their money to these companies, and in return, the investor is paid a predetermined number of interest payments on predetermined dates. So so understanding what factors to you should look at before investing in a bond. So the primary one is obviously the tenure of the bond. That is how long the bond will take to mature, and also how much return will it give. The other factors that are involved would be the bond's rating. So you can check a bond's rating in case they are determined by a third party like CRISIL or CARE. So the higher the bond is rated, the more secure it is, and the lower it is rated, the more riskier it is. So, so the other factors that you should also look at is whether there is a debenture trustee or not. So, uh, a debenture trustee is a third party who keeps a periodical check on the issuer, and he also ensures that the issuer is capable and has and doesn't has is not facing any problems in terms of repaying the predetermined uh, payments to the investors. Also, the final thing would be the collateral. So if you are investing in a secured bond, in that case you need to check on the strength of the collateral and the cover that it gives on the actual investment. So taking an example of this bond Archmed that is already listed with Altius. So as you can see, first thing that you look at would be the return that the bond is giving. So this bond is giving an IRR of 13.5%, and the tenure for this bond is 15 months. Then you can also check the rating. When the rating for this is triple B minus, which is considerably secured, and also you there are they have predetermined the payments that they will give out. So you will receive a monthly interest payout of 13.5%, and the principal that you have invested that you will receive on its maturity. So there are different bonds that actually give out payments in different structures. For example, this bond is giving out interest payment monthly and the principal is paid out at maturity. There can be bonds that pay the lump sum amount, that is interest plus principal, at its maturity, and there can be bonds that pay out the interest as well as the principal on a periodic basis. So let's take a look at the cash flows of the Arthmate. So say for example you are investing rupees 2 lakhs at on 30th of October in the security. So this is how the payments would look like. So they are giving out 13.5% in annual interest, and they are paying it out on a monthly basis starting 30th of November. That is the last day of the month for November, and they are giving it out for the next 14 months, that is 31st of December 23, and on the 15th month they will pay out the interest as well as the principal that you have invested. So this is how the payment structure looks like when a company is paying out interest on a monthly basis and returning the principal on the maturity of the bond. So moving forward, let's take a look at a different type of fixed income product, that is government securities. So government securities are basically securities that are backed, debt instruments that are backed by the government of India, and they have historically been proved to fetch better returns when compared to traditional fixed deposits. So government securities are basically of two types: the bonds that are issued for less than 1 year, they are called T-bills. These are short-term debt that the government issues, and the second one is government bonds. These are the bonds that have a tenure greater than 1 year. So looking at an example for T-bill. So say for example uh, you are investing in a T-bill tomorrow that matures in the next 364 days, and its face value, that is the value of the T-bill, is rupees 10,000. So T-bills are basically zero coupon bonds that are available, that can be bought at a discount. So as I said earlier, this is a 10,000 rupee. The value of this T-bill is 10,000 rupees, and it is you can buy it at a discounted price of 9,420, and on its maturity you will receive the actual value of the bond, that is whole rupees 10,000. So basically you have earned a return of close to 6.1% on this investment. So government securities are basically the most secure investment type that you can find in the market. Okay, so moving forward, this is the third and final type of fixed income product for today. So these are market linked debentures. So market linked debentures are basically structured product which uh, give you a return that is linked to the underlying index. So the underlying index could be GSEC or Nifty. So in this case, the when you are investing in a MLD, your capital is always secured. And to understand it better, let's take a look at an example, that is the product from Edelweiss. This is called the Twin Win. So in this MLD, they have mentioned that when you invest in this MLD, you either earn fixed return of 6% per annum, that is payable at maturity, or in case the other condition is if Nifty 50 index gives a return more than 6% in the next 3 years, then Twin will give you the exact returns that the Nifty 50 has fetched in the 3 years, and that will be your total return. So you either earn 6% in case the market hasn't performed well, and in case the market has performed well, you earn the returns that the market has actually fetched. So in both the cases, you are the one who is going to be beneficial, and the minimum promised return on this investment is 6%. So talking a bit more about this product, the maturity period for this product is 3 years, and also the uh, minimum investment in products like MLDs is a bit on a higher side. The minimum ticket size is rupees 10 lakhs. Okay. So moving forward, let's take a look at the benefits of investing in such products. So the first one is obviously the diversification opportunity that they give you from the stock market. So fixed income products are basically have a very low correlation with the actual stock market. Hence, you get an option to diversify your portfolio in these instruments. Second one would be you get an opportunity to invest in an instrument that can fetch you a regular income and regular and pre income on a predetermined date. Also, if you have invested in a diversified, you have created a diversified portfolio of fixed income products, your even your capital is preserved. There is very less chance of you getting any negative returns. And the last one would be you get an option to choose from a large variety of products that that matches your risk return profile. So looking at some of the risks that are associated with the fixed income. So first one would obviously will be the interest rate risk. So what happens is if the interest rates in the markets rises, then in that case the uh, price of the bond decreases. So you should consider this risk. You should look at this risk only if you are planning to resell the bond in the secondary markets or or on the exchange. But if you are investing it for till the maturity, then you shouldn't be worried about this risk. So second one could be the inflation risk. So so in cases where the inflation actually goes above the actual return of your bond, then in that case you are losing on your purchasing power. The third one would be the credit risk. So this is the risk where associated with the issuer. So in case so basically this is the default risk in the repayments of interest as well as the principal that you are exposed to. And finally it is a liquidity risk. So the these fixed income products are not easily resellable. So hence, once you invest in it, there is a good chance that you'll have to hold it till its maturity. So coming to this slide, what we advise is for you to create a balanced portfolio in the fixed income products. This is to diversify your investments that will help you reduce your risk and will not and it will also cause a very insignificant impact on your returns. So what we suggest is that instead of investing a large sum, that is say for example 10 lakh rupees in a single high yield or in a good yield bond, that is say for example you are investing rupees 10 lakh in a bond that fetches around 11 to 12% of return. So what we suggest is that instead of doing that, what you should do is you should diversify. You should invest it in, say, 8 to 10 bonds that have a different risk to return profile, and the only risk that you would be exposed to would be the credit risk. That is, in case if any of the one bond defaults, only in that case you will be losing a minute return on your investment, or else you will be safeguarded your against any of the risks. So instead of investing a large chunk in a single bond, what we suggest is that you diversify your investment and invest one or 2 lakh in say 10 different bonds. Yeah. So looking at risk return of all the assets that we talked about and comparing it to the listed stock market. So the government securities are considered to be the safest, as they are practically risk free, as they are backed by the government of India. So it fetches a low return and also has the minimum risk. So when you are investing in government securities, it gives you the T-bills that are the short-term government securities. They usually give you a return of around 5 to 6%. And if you are investing in a government bond, then it fetches you a return of 6 to 7%. So next is the corporate bonds. Corporate bonds have a higher risk when compared to the government securities, and even the returns are higher. So they you can categorize as a l- low risk, medium risk and medium return investment. So corporate bond fetches a return from anywhere between 11 to 13%. And moving forward, the MLDs. MLDs are market linked debentures. The return are always fi- determined by the underlying that it is linked to. Say the example that we looked at earlier, the twin wheel, it is linked to Nifty. So that would actually fetch you a return close to 15 to 17%. And moving forward, the listed equity listed equity are considerably more riskier and also fetch better returns from the fixed income products, but again they are riskier. And finally, there is unlisted equity. Unlisted equity has been proved to give a um, CAGR of around 25% in the past 4 to 5 years, and they are considerably more riskier when compared to listed equity. Let's look at this slide. This is the uh, investment options that we have brought onto our platform for our investors. So uh, the first one is obviously that we talked about earlier, the government securities. They fetch a return of around 6% and are practically risk free, as they are backed by the government of India. And the average tenure for the investment can be from 3 to 12 months. Then okay, so the type of products that are available in the government securities are basically the T-bills. On our platform, we have listed a 91-day T-bill, a 182-day T-bill, and a 164-day T-bill, depending on the tenure that you are looking to invest and the returns that you are uh, willing to invest for. The second one is the corporate bonds. So we have listed a wide uh, variety of corporate bonds on our platform. So there is a sorry. So on an average, corporate bond would give you a return of 11 to 13% depending on the uh, risk profile of the issuer. So the corporate bonds ideally have a low risk, and the tenure for the products that we have listed on the platform is on an average 12 to 24 months. So on our platform we have listed Arthmate, uh, we have Rupeek, a product from India Bulls. Uh, we had earlier listed KNS infrastructure, which is sold out, and it actually fetched a return of close to 16 to 17%. So it was a bit on a riskier side, but also the returns were really good for the product. So the third one are the MLDs. So the average return would be linked to the underlying, that is Nifty, and they are considered to be low to medium in the risk profile, and the fetcher and the ideal tenure for these securities is 2 to 3 years. So on our platform we have listed Edelweiss Twinwin that we actually discussed earlier. So when you invest in Edelweiss Twinwin, in case the market uh, the Nifty performs or gives a return of less than 6%, then you earn a fixed return of 6%. And in case it gives a return more than 6%, then you earn the return that Nifty is giving you actually. So say for example, if Nifty gives you 10% of return, then even this product would give you a 10% return. Now finally, we have pre-IPO on our platform. Pre-IPO has pre-IPO companies like Chennai Super Kings, Farm Easy, Hexaware, Studs, Accessories, and there are 100 plus private companies listed on the platform. So a balanced investment in these companies gives you has proven to give a average return of 25% over the past 5 years. So the risk profile of this investment could be medium to high, and the tenure that we recommend for the investors to invest in these companies is from 2 to 3 years. Okay. Uh, Now, looking at the some of the investment opportunities on our platforms. Okay, so looking at some of the opportunities that are currently listed on the platform, we have India Bulls, Housing Finance, ECL Finance. This is basically a commercial paper that has a uh, tenure of 6 months, and it fetches you a return of close to 8.7%. The other one is Ugoro Capital, that is a senior secondary listed redeemable NCD. It fetches you a return of 10.4% and the tenure is 18 months. And the minimum investment in this product is 1 lakh. So let's see how we can place an order for this security. So on the platform we have listed as to what is the current rating of the issue, what is the return, what is the tenure of the product, and what will be the redemption date. You can read a bit more about the company, the summary of the opportunity, and yeah, a bit more about Ugrow, how they have, what is their financial profile, and also in the deal structure you get to see what the repayment structure would look like, and uh, a bit more information on what is the security cover and what is actually the security. So say if you are willing to invest, you are willing to buy 100 quantity of this. So you just need to enter the quantity and click on invest now, and once that is done, you can make the payment of for this security, and after making the payment you would be able to see it in your uh, order book, and also once the transaction is complete it will be reflected in your holdings as well.